Hello, everybody. Welcome to the Verdance Capital Advisors 2020 review and 2021 look ahead. My name is Leo Kelly. I'm the CEO of Verdance Capital Advisors, and it's our pleasure today to bring you our view of this extraordinary year that has just passed us, that is 2020, and a look ahead into what we're seeing in the future for the markets and the economy. Now, normally we start this with a review of our 2020 predictions and our themes from prior year. And we go through and we check the boxes for good ones and we minus sign the bad ones. And this year we're just going to give it a universal COVID stamp. Any discernible measurement of the markets really was thrown out the window in what was a year like no other. A true global event that shut the world economy down and had dramatic impact across all financial markets. And in fact, in March, the global financial markets were under extraordinary strain. And yet, we sit here in January 2021 with the stock market making new record highs, with global economies recovering. And that is an extraordinary example of what we talk about all the time. And that is not falling into the pain of emotion during extreme market stress, staying consistent in your process, because the markets have a way of working through these remarkable events, and none more remarkable than the one that we saw in 2020. So as we dig in, market returns ended up being exceptional. We have record highs. Now, it was a very bifurcated return market, and that's really probably the biggest story of 2020 in terms of the market. Growth stocks, technology stocks specifically, and the largest market capitalization stocks had exceptional years. And that was, as everybody now knows, the stay-at-home economy stocks soared. And so as we look at these returns, the NASDAQ, the 2,500 growth, 2,000 growth, 1,000 growth, all of the growth indexes had just amazing years. Value-oriented stocks, and that would be financials and banks and industrials, obviously with the massive turn down in the economy, struggled. And in fact, during the year, we're down some cases 40, 50% at one point during the year. So a very different year depending on which segment of the market. But we saw a very rapid recovery in the fourth quarter, and all stocks were buoyed. The water rose all ships. International stocks, again, started very slow. We had the big dramatic downturn, very dramatic recovery, specifically, as you can see on the chart here, in Asia, which got the virus first, came out of the virus first, saw the recovery back first. So good returns in Asia, less so in Latin America. And then, of course, in the fixed income markets, interest rates collapsed as the Federal Reserve drove down interest rates, trying to support the economy and build some momentum behind a rally, a recovering rally in the economy. So that was the story this year. Commodities, we saw precious metals go up handily. Makes sense in times of stress. That's exactly what happens. Energy collapsed. Now, it has recovered quite a bit, but I want to put a point on the energy. Oil went negative this year. How crazy was 2020? Oil went negative. Oil prices were -0. Never seen anything like it. That shows you just how crazy 2020 was, and started to rally, but the overall returns very, very poor. So 2020 in review. I think this chart says it all. It's a mishmash of just craziness. Politically, we had a very loud year. I say, the music was very much the same. The volume was turned way up this year. And so the environment was really charged. So when you add shutdowns and debates over shutdowns, and you add this highly charged political environment with an economy that was going through incredible turmoil and a very volatile stock market, I think we're all 2020 fatigued. And I think we're all looking forward to whatever normal is, a return to normal in 2021. And I think the market is telling us that we're looking forward to as well. We'll dig into that. So a lot going on this year, maybe more than a normal year in terms of the news flow, but none more dramatic than what happened in March. So the coronavirus comes, we know this, it shuts down the economy. How dramatic was it? Well, this next chart shows in the first quarter of 2020, we dipped into recession. A recession is 2 quarters of negative GDP. We saw negative GDP, which is actually in the first quarter, one of the more dramatic downturns that we've seen relative to history, but none like the second quarter. Second quarter, we set a record for GDP drop, 33%, like no other. Now, obviously, that was a forced GDP drop when the government shut the economy down and everybody had to stay home. We had a huge recovery in the third quarter, again, back up 33%. And then the first quarter, the estimate is continued growth at a higher than normal pace. We're not back all the way above zero yet, but the pace of the recovery has been significant. And for anyone who watched our coronavirus video updates, this was our expectation, a V-shaped recovery because of massive stimulus given out by the U.S. government, because of massive stimulus by the Federal Reserve, and because of the condition of the consumer, which we'll talk about in this analysis. So, the worst recession of all time, and then the fastest recovery of all time sums up what we saw in 2020 from an economic standpoint. Now, in terms of jobs, we're still going through the reconstruction of the job market, as you can see on this chart. In actuality, if we go back to the last major recession, which was 2009, which was basically as bad as it gets from a financial standpoint, we had a massive recovery in jobs over the last decade. And in just a couple months, we lost all the jobs that we had created over a 10-year period due to coronavirus. Now, the good news is the jobs are snapping back very rapidly, again, in this V-shaped bounce. That's starting to moderate a little bit. It's going to be a little bit harder work to get this going. Obviously, with vaccines starting to come into the system, that is, for us, what we're hoping is going to start to stimulate the job market to again, that return to normal, which is thematically what we're going to be talking about, is trying to bring it back to normal as these vaccines hit. Aggressive monetary policy was, without question, maybe the biggest financial theme of the year. This chart shows the federal funds rate and the Fed's balance sheet. And what we saw was the Fed dropped rates to incredibly low levels, and they poured money in the system. So I want to put this in perspective. Prior to the financial crisis in 2008-09, the Fed had about $400 billion in their balance sheet. It went to $4 trillion after the crisis. And as you can see on the chart today, we've surpassed $7 trillion. This is just from the Fed. This doesn't include stimulus from the government. Massive amounts of money in the system at very low interest rates. That does have an impact, both short and long term. We're going to talk about those impacts. One of the impacts is housing. Housing was the clear winner in 2020. And there's a lot of reasons why, and we saw incredible movement from certain areas of the economy to others, from cities to the suburbs. We saw from some states to other states. We're seeing movement, but overall, housing did incredibly well. One reason, remarkably low mortgage rates. The U.S. consumer stayed strong. They stayed strong because of stimulus and because of prior sins in 2009. But the consumer is strong. Mortgage rates collapsed. The beneficiary of that, housing. So you can see by this chart, existing home sales exploded to the upside as mortgage rates came down to record lows. So housing very strong and very much helped this economic recovery. I think the other big story here in interest rates is what we're seeing in the bond markets all over the world. There is an extraordinary event happening in the fixed income markets globally. And that is, if you go back to the last financial crisis, there was no such thing as negative yields. Of course, if you buy a bond, you need to get a rate of return. Sometimes it's low, sometimes it's high. Fast forward to today, and we're at approximately $18 trillion of negative yielding debt. Again, let's put that in perspective. You want the government to hold your money, you have to pay them. They don't pay you a yield. It's absolutely like nothing anyone's ever seen. This has long-term dramatic impact. This has to be unwound eventually. But All of this stimulus, all of this money over two financial crises is really starting to show an enormous impact in the fixed income market, and that accelerated 2020. Across the board, the big story in the stock market itself was the size of the rebound. On this next chart, you see global equity returns across various different countries, and you see the drawdown in 2020. Drawdown is how far it goes from top to bottom. Just look at these numbers, 37, 34, 38, 47, 40. Across the board, massive, massive declines, not just in the U.S., but across the board. U.S., of course, 34%. And if you look at the total return at the end of the year, most are positive. The U.S. market from down 34 to up 18. Again, that's an enormous return, an enormous return. And so the story, again, the V-shaped bounce, the V-shaped recovery, that was our base case. I would also say, in terms of looking forward and trying to really understand the recovery, the most prominent point in returns this year was how narrow the trade was. A record narrow market. This next chart shows you that more than 50%, almost 60% of the return of the S&P 500 was only 5 stocks. Now again, that's the S&P 500. So 5 stocks is 1% of the amount of stocks had almost 60% of the market's return. That is, again, that's completely different than the norm. We haven't seen this since 1999. It's actually a record. It's more dramatic than 1999, which was the year before the tech crash when we saw very, very similar statistics. By the way, number 5, the 5th through the 20th, added another 20%. So now take 20 stocks and you're at 80% of the return. So when you see S&P 500 up 18%, remember, 14% of that's 20 stocks. Only 4% is the other 480. Two different markets here. So when you're looking at portfolios and you're trying to evaluate and ask the question, why is the market up so high when the economy's not doing well? Well, the market may be high, but all stocks are not. It's one small group driving the return. That's incredibly important in terms of analyzing the market from last year. So what does that mean? Well, if we take this next chart, which is the S&P 500 market cap total return minus the equal weight return. So what does that mean? The S&P 500 is market cap weighted. So those top 5 stocks drive the return. It would be the equivalent of if I came and said, I'm going to invest $1 million in Microsoft, but only $10,000 in Caterpillar. Well, that doesn't really make sense for a portfolio, but that's what the S&P 500 is. There is an S&P 500 equal weight index where all stocks are the same. And the equal weight index dramatically underperformed. How much so? Again, we have not seen anything like this since 2007. And the time before that, as you can see on the chart, 1999. No coincidence. Both those years were right before a pullback in the S&P 500, a significant one, because that small group just got too high. So that's 2020, an amazing year in a very, very brief analysis. More importantly, what do we see going forward? These are our main themes for this year. We're going to go through each one of them. The U.S. economy, again, a continued slow start in the first half as the vaccines roll out. We continue to fight through certain shutdowns. We continue to fight through the employment issue. But we think there's going to be a very rapid recovery on the second half and beyond as we set up for global growth. Fixed income, expect very muted returns. There's so much money flooding the system that it's hard to imagine you're going to get excessive returns from fixed income. And we do think that these moves are inflationary, which can drive up interest rates. And again, as a reminder, when interest rates go up, price of bonds goes down. We have to be very careful with what we own in the bond market. Global equities, policy is very supportive for global equity growth. We're setting up for economic activity and a very good accommodative financial position globally. So we do think equities look interesting, but selection is key. This is different than what we've seen over the past many years where you just put the money in the market and it goes up or down. We think now selection is going to be more important than it has been since 1999-2000. Alternative investments, still wonderful opportunity here. They have not done what the public market's done. There's valuation opportunities in the private markets, And we think volatility is returning. And so having hedging instruments in your portfolio to moderate volatility, very important. We like the alternative investments. So our themes: economy recovers, fixed income is a dangerous place. We've got to stay conservative. Global equities should remain strong with volatility, and alternatives, put some more money there, and probably a good time to overweight.